Hello everyone. In this session, we have to study about computation of gross annual value and tax liability under house property. Friends, as you know that there are four types of house properties, that is self-occupied house property, house used for own business or profession, let out house property, and deemed to be let out house property. So tax calculation same in the case of let out as well as deemed to be let out house property. So in the case of self-occupied house property, gross annual value of the house property is nil. So we have to consider these three steps for the purpose of computation of gross annual value and tax liability under house property which is let out or not let out, means it is to be treated as a deemed to be let out house property. So the first step is related with reasonable lettable value, and reasonable lettable value is to be calculated by considering municipal valuation, fair rent and standard rent. But the rule is we have to consider the two amounts, that is municipal valuation or fair rent, whichever is higher, that is to be taken, but it is subject to standard rent. So whatever least amount from these two is to be considered as a reasonable lettable value, means least of this or this is to be considered reasonable lettable value. Then in second step we have to consider actual rent received. Actual rent means annual rent minus unrealized rent, and rule is that if actual rent is more than reasonable lettable value, then such actual rent is to be considered as a gross annual value, and if actual rent is less than reasonable lettable value, then third step is applicable. And in third step, if it is less than reasonable lettable value, we have to calculate the gross annual value as actual rent minus loss due to vacancy. So whatever amount calculated by using either these three steps, that is called as a gross annual value. Means if there is no actual rent, we have to calculate reasonable lettable value, and only this value is to be considered as a gross annual value. If there is actual rent and it is more than then reasonable lettable value, then second step is applicable. If the actual rent is not less than, then third step is not applicable. But if it is less than reasonable lettable value, then third step is is to be considered, and the annual value is to be calculated. So once annual value has been calculated, then the gross annual value is considered for calculation of calculation of taxable liability under house property. Once gross annual value has been calculated, then we have to consider whatever municipal taxes paid by the owner, that is to be allowed as a deduction, and once has been allowed, we have a net annual value. And in case of let out or deemed to be let out house property, whatever net annual value is there, deduction under 24 is allowable, that is standard deduction is 30% allowed on net annual value, means whatever annual value is there, we have to calculate 30% on that net annual value and allowed as a deduction. And second deduction is allowable as a interest on loan taken for construction or purchase of that let out or deemed to be let out house property, and there is no statutory limit for interest on loan in the case of let out or deemed to be let out house property. Means whatever interest on home loan is there, or whatever interest paid by the owner on let out house property is allowable as a deduction. Okay, so this is a common format for calculation of computation of gross annual value and tax liability under the property which is let out or deemed to be let out house property. Thank you.